If it's a scam, how can it make you rich? If one financial guru can't stand the thing, why does another one love it? And if this Redditor was conned into buying it and now risks eviction of all things because of it, why are they saying in the same breath that it can work for some people? How do these contradictions make you feel? Are you confused, curious, hesitant, annoyed, or feeling something else in that unique mind of yours? My name is Slater, an independent life insurance broker, and today I have for you a whole life insurance story straight from Reddit, a social media platform that can only rival Twitter X and Juicy Deets. A teacher by the moniker Great Change relates their situation well, saying they were conned into buying whole life insurance. But just how true is that? There's no need to put you in suspense. Great Change was scammed, and undeniably so, but not in the way you might think. I can assure you that this financial product is a godsend for those who want safe and stable growth, while providing crucial coverage that could lead their families to financial peace of mind, if not complete financial freedom. But hey, I shouldn't get ahead of myself. Without further ado, let's investigate the case of Great Change's whole life insurance policy and what you need to know to make sure you don't fall for the same underhanded tricks and tactics. The date is March 2023. An insurance agent approached Great Change, offering his services. It's not clear whether he was responding to a quote request or if Great Change was a referral, but history is history. What matters most is that the two ended up meeting about life insurance. It's a bit strange that a Redditor here would want life insurance in the first place, considering they have no dependents to protect with the product's tax-free death benefit. But it seems like the agent already foresaw that. He offers a whole life insurance policy, not for the coverage, but for retirement income. A bit like a pension fund. Perhaps due to the agent's rapport building acumen or slick sales skills, the teacher did not pose any resistance to signing on the dotted line. The catch? Nothing really, unless you consider paying $900 a month on a 44K annual salary a catch. So, off the teacher went to work, putting in a quarter of their pre-tax income or a third after taxes, month after month, into the policy in hope of future financial freedom. It goes well for a while. They go to work, pay bills, buy groceries, but eventually the steep price catches up. I'll just tap into my savings, Great Change thinks. After all, the insurance policy is just a savings vehicle anyways. It's like shifting some money into an index fund, IRA, or certificate of deposit. What's the worst that could go wrong? Fast forward a year and a half later. The educator in question drained all of their savings to fund this policy, had no money left in the bank to pay rent, and as for the quote-unquote retirement funds they could access inside the policy after months of high payments, $1,200 and nothing more. That's around 7% of what had been put in at that point. The OP could only ask in desperation, what do I do now? Before we review what went wrong in the aforementioned plot, we have to lay down some basic principles on how insurance works. You see, insurance would not be possible without actuarial science. The root word, actuary, comes from the Latin actuarius, which translates to account keeper. Actuaries make use of advanced math and statistics to keep account of risks, which might more specifically be understood as uncertainty regarding future outcomes that can have financial consequences. For example, car insurance uses actuarial science to determine how likely a teen is to get into a car crash and how the company needs to charge an extra premium to protect against that risk while still turning a profit. Health insurance uses actuarial science to say which conditions, surgeries, and medications should be covered and at what copay and deductible. Life insurance uses it to make educated guesses regarding how long a person will live and what amount of coverage they should be allowed to get based on their health, income, gender, and other factors. But whole life insurance, whole life insurance is a little special. She isn't like the other girls. Let me explain. Even though insurance protects individuals from risk, death is not a risk. You will die. No one knows the day or the hour, but the Grim Reaper will come for your head at the appointed time. That creates a dilemma for the actuaries. How do you design an insurance product that must pay out because the risk is not a probability but a necessity? The solution they came up with is that every whole life policy essentially allows the policyholder to pre-fund the death benefit or the payout that will be dispersed when the insured person passes away. This pre-funded amount is called the cash value. The equation for the cash value is, conceptually speaking, rather simple. You make the payments or premiums to maintain your coverage and subtract operational and administrative fees that are taken out to keep the insurance company running. The fees are significant early on, such that your average policy does not have any cash value in the first 2 years. But I'll tell you the trick to having an above average policy in just a moment. Anywho, you also have to know that the cash value must grow with compound interest every single year until it equals the death benefit at age 121. At that age, the policy will endow or pay out to the beneficiary in cash if the insured individual is still alive. What's more, the cash value can be accessed as needed for whatever purposes you want. Retirement, vacations, furry conventions, Taylor Swift concerts, college expenses, buying a house, or any other typical American expense. Access can be achieved through 2 methods. The first is through withdrawals, like you would withdraw money at the bank. The downside to withdrawals is that they permanently reduce the cash value and death benefit. So, if you have, say, a $100,000 death benefit and you withdraw $10,000 from however much your cash value is, your death benefit will forever be reduced to $90,000. And please keep in mind that these withdrawals are taxable if you ever touch the interest. Are we cool? Cool. The second and more common method is to utilize policy loans. These loans allow you to use the death benefit as collateral, a familiar concept to anyone with HELOC experience in real estate or margin account know-how in the stock market. Policy loans are tax-free and, strictly speaking, do not have to be paid back, but they do accrue interest as the clock keeps on ticking. If the loan interest overtakes the cash value growth rate, your policy might run out of cash value and lapse, meaning you will no longer have life insurance. But keep in mind that it's the total cash value that gains interest, even while the borrowed money is also accruing interest, meaning that borrowing $1,000 from $10,000 of cash value results in gains on the $10,000 in case you pay the loan back. Because remember what you learned just a moment ago, the total cash value must equal the death benefit by age 121. So nothing can stop this compound interest machine, not even the loans. At this point, I want you to say to yourself out loud with me, my brain is bigger than Gabriel Iglesias, its form is wrinklier than Hillary Clinton, and its IQ grows faster than the US debt. You see that it could be nice to use whole life insurance as a tax-free asset through withdrawals so long as you don't touch the interest. through loans that can be leveraged and paid back as you please, and through cash value that will grow year over year without stock market risk. However, a few things are holding you back. For starters, the cash value is capped by the death benefit, since that's what you're paying towards until endowment. Moreover, those pesky fees mean it could take quite a few years to see meaningful gains. Plus, you're probably not making it to age 121 anyways, so you'll never feel the full effects of compound interest. Unless there's a way to raise the cash value and death benefit in the short and midterm, you don't see where the appeal is. But luck would so have it that there is a way to enlarge that death benefit and accelerate your cash value growth early on. And it's called a paid up addition. Terminology in the life insurance industry notoriously makes no sense at all, so let me break it down for you. A paid up addition is when you pay for an additional death benefit. And since a paid up addition locks that death benefit in place without needing any further payments, we say that the death benefit is paid up or paid in full. This is in contrast to the base death benefit, which is typically paid off over the course of many years. We agents in the industry usually refer to paid up additions as PUAs for short, and I will continue with the tradition in this video so my tongue doesn't get tied too much. Simple enough? Sure, but how do you get PUAs? One way is to get a PUA Rider, which is an add-on that you can get when applying for certain whole life policies. How much does this rider cost? Well, let's say you want to set aside $1,000 a month for a retirement-focused whole life policy, like our teacher here. Well, you could put in 100% of the premium into a base policy with no PUA rider. That's not optimal for retirement, since the cash value and interest earning potential is limited early on. So instead, you choose to split up part of your premium into the fee-heavy base policy to fund that initial death benefit over time, and another part to take care of the PUA rider that has a small enough fee load to where most of it goes to the cash value. Depending on the company and your own personal preferences, somewhere between 60 to 90% of your premium will go into the PUA rider. Now, more isn't necessarily better, but we'll touch on that topic later in the video. Another way to get PUAs is through dividends. If you are familiar with stocks or have an account at a credit union, you might very well already be familiar with dividends, but let me explain the concept anyways, since they work a bit differently in whole life. According to the IRS tax code, a life insurance dividend is defined as a return of premium. A common interpretation is that you're getting a return of your premium that you're paying every month, similar to a rebate or discount. But that's a major misconception. Here are the facts. Only not-for-profit life insurance companies can pay out dividends because, as the name implies, they cannot keep their profits. How do life insurance companies earn profits? They receive premium payments from policy owners. If premium is effectively the only way that these life insurance companies make profits, and they can't keep those profits, then return of premium might be better understood as a return of all the company's premiums, or a return of the business's profits. TLDR, a dividend is your cut of the company's annual profits, and generally speaking, the more profitable the company, the larger the dividend payout. Now, you can choose to allocate your annual dividend in a number of ways. You could get a check in the mail, reduce your premium payments, leave them at the company to grow interest, etc., etc. But the most common strategy is to use your dividend to get PUAs above and beyond the PUA rider. All things being equal, the dividend grows year over year as your policy matures and can realistically pay out tens of thousands or even hundreds of thousands of dollars in the long term. And again, that's at no cost to you besides owning the product. And while dividends are not guaranteed, many companies have consistently paid out dividends every single year for over a century. From my personal perspective, dividends are the single most powerful component of a whole life insurance policy. And while I have to put an asterisk here, not to give any financial advice, I would not recommend anyone to get a policy intended for cash value accumulation from a company that doesn't pay dividends. But hey, your life is your life. Live it as you please. Congratulations! You're now an expert in whole life insurance. While there are some things here and there we haven't talked about, you can understand our Redditor's situation quite well through actuarial science, cash value, PUAs, and annual dividends. So let's review their story, knowing what you know now. For starters, the teacher was paying $900 a month into the policy. You're thinking, that still sounds like a lot for someone earning 40K a year, but how much of that is going into the cash value through PUAs? Then you recall that only $1,200 were in the cash value after a year and a half of payments. That's low, you say. If Great Change was putting in 60 to 90% of the premiums into a PUA rider, then even after fees, shouldn't there be several thousands of dollars for them to access? That's right. The 1,200 here is only from the annual dividend. While that's a pretty sizable dividend, the cash value is pretty pathetic. So, wait. You're telling me that they were paying an unsustainable premium without even getting a PUA rider? That means this policy wasn't optimized for retirement in the first place, even though that's what the agent promised. Yeah, that's exactly what I'm saying. And ain't that a shame? I was able to replicate the policy pretty closely using illustration software, which is how life insurance professionals calculate the actuarial projections for how a policy will perform in the years to come. I do not know the exact company, but I think it's fair to assume that the following scenario can't be too far off from the original. Let's assume the teacher was a 36-year-old, non-smoking female with a pretty average health history. With this bare bones policy she purchased, we're looking at a projected $496,000 of cash value at age 65, which technically isn't too shabby for retirement. But the optimal retirement policy that I was able to create, with 90% paying into the PUAs, had a cash value of $19,000 at the end of year two, which is almost 16 times the money that was in the initial policy at that point in time. And age 65 would have left her with $545,000, 40,000 more than the base policy, or nearly another year of her income. What's more is that some other company could illustrate even higher results. Remember how I said more money into PUAs isn't necessarily better? That's because different companies have their own dividend strategies. The one that we're looking at here pays large dividends up front, but the long-term growth potential is rather modest. So this company actually optimizes for short-term liquidity needs, like for a real estate agent who needs to deposit and borrow large sums of money to make deals for business needs. While you can use this company for retirement just fine, why not settle for more for the same price? After all, your life is worth it. By selecting a company that prefers to pay smaller initial dividends that increase exponentially in the long term, but maxes out at 60% going into PUA riders, sure, she would have only had $5,570 of cash value at the end of year one. But the cash value at age 65 would have been a massive $624,737, which is almost $130,000 more than the policy that the agent sold. That's 3 years worth of her pre-tax income. And of course, this is all assuming that the teacher would have still been paying $900 a month. Realistically, the Redditor should have only put in 10% of their income into this strategy, or maybe up to 20% if they really wanted to go all in. But that's $300 to $600 a month, not $900. So what's the deal with that? There can only be two reasons this agent sold a policy like this. Those are ignorance and greed. To speak on ignorance first, the life insurance industry is not one in which brain power is encouraged. The course to get a license only takes about a week or so to complete, and most agencies will immediately get agents on the phones or knocking on doors as soon as humanly possible, which is usually just another week. There's no time to learn anything about anything, and you have no incentive to invest in education either, because if you're not selling, you're not earning. I wouldn't be surprised if the agent was taught to pitch overly priced base policies by their upline and just rolled with it. Of course, it's obviously not right, but it is the reality. As for greed, I think that speaks for itself. Or does it? While it's pretty obvious that $900 a month pays a better commission than $300 a month, that doesn't explain why there was no PUA rider at all. Well, what I didn't tell you was that there's a different commission structure for the base premium and PUA premium. If base premiums pay, say, 55% commission, PUAs could pay 5%. And since a good whole life policy built for retirement is usually at least 60% PUAs, that could really kill an agent's commission. Now, don't get me wrong, I don't want to spread misinformation. There are some situations where you don't need the PUA rider even for retirement income, but this is not one of them. This agent could have earned $6,000 from this single policy when a properly structured policy would have paid out less than $3,000. The only person who could benefit from this scheme was the agent, when the client was left with nothing. As an old sailor and business owner once said, the money is always right. And even so, despite how much it frustrates us that agents are either too money-loving or too uneducated to sell life insurance ethically, let's take a step back, take a deep breath, and think of Season 2, Episode 36B of SpongeBob SquarePants, entitled Krusty Love. In this episode, Mr. Krabs realizes that he has the hots for Mrs. Puff, SpongeBob's PTSD-inflicted boating school instructor, after she stops in the Krusty Krab for a quick bite. Unfortunately, Mr. Krabs is still deeply enamored with his first love, money. He finds himself constantly torn between offering gifts to the apple of his eye and hoarding his wealth under his mattress instead of gaining compound interest in a whole life insurance policy. SpongeBob, sweetheart that he is, tries to manage his boss's wishy-washy behavior by catering to his every whim, but in the end, even the friendly fry cook snapped, using language that was so, let's say, innovative, that Mrs. Puff needed to pull out a print copy of Urban Dictionary to understand its many nuances. Mr. Krabs very much reminds me of the average life insurance agent who has to balance bills with serving clients. On the one hand, he wants to be the best agent he can be and change the world with his services. After all, when his clients die, he'll be the only one showing up with a check, while lenders and funeral homes need their accounts settled. On the other hand, he needs to eat and is willing to do what needs to be done in order to provide. The client, Mrs. Puff, is not particularly informed about how life insurance works. Sure, it pays a death benefit at her passing. Isn't that all she needs to know? But what was that he said? Whole life insurance can be used as a retirement vehicle? Mrs. Puff wants to know more. And it's all too easy to tell her one thing and mean something else. All too simple to weasel out a few more dollars from her purse. But Mr. Krabs cannot serve two masters. And the master he chose was the green monster who lived in his wallet. But as I was writing the script, I realized something. We are Spongebob. In this scenario, we are nothing more than onlookers. We can get mad, rant, complain, and storm off in a fit of rage. But that, my friend, doesn't achieve anything. What we can do is educate ourselves to make sure things like this don't happen to us and our loved ones, because relying on know-nothing agents to handle our financial futures is like having a known predator babysit our children. It's not a risk, it's just wrong. One time, after failing to close a potential customer, I decided to look up some articles about the product I was offering because I wasn't entirely sure if she should have gotten more coverage through me in the first place. After all, she already had a policy somewhere else, and it was probably good enough for her purposes. When I brought my questions to someone experienced in the industry, I didn't get the reaction I was expecting. They often interrupted me and seemed frustrated by my curiosity. After giving me some product knowledge in a rather dismissive tone, they recommended, of all things, that I should stop reading. I was told that it would be better if I just closed my eyes and opened my ears to the echo chamber of a few uplines and managers, that seeing what was out there would only end up confusing me. I felt pretty unenthused once I got off the phone, and my trust in that person vanished into thin air. Trusting blindly is simply not who I am. The reason I delve into the functions of life insurance is so I can truly help someone like you feel assured that the policy you have is the right one. I want you to be able to click my booking link or fill out my insurance needs form, or heck, just watch my videos without feeling like you'll be the next person to sign up for a Reddit account trying to salvage whatever money you have left, trying to rebuild your life savings from scratch. I need you to know and feel that I'm in this industry because I want to be, not because I can't get a job somewhere else. That's the kind of future I want to build for myself and others. What kind of future do you want to build? Thanks for watching my video until the end. Like I said in the beginning, my name is Slater. I'm the founder of Ling Life Insurance Solutions, an independent practice that I created because I felt like too many agencies focus so much on selling and recruiting instead of teaching. I I wanted to make a YouTube channel to bust myths and give consumers a proper education, but this is actually my first YouTube video. The script was in the making for quite a long time until I found a style that I felt reflected myself and my brand. So please let me know down in the comments what you thought of it. And if you'd like your own life insurance policy, feel free to check the description or pinned comment to book a call with me directly, or fill out the insurance needs form so I can review your financial situation and give you some personalized options that could align with your unique situation. Otherwise, I look forward to all the content I'll get to make for you in the future. But just remember, don't say later, just go with Slater. See ya!